Now let's see the operating exposure. So definition of operating exposure. Unlike the exposure of asset and liability, I mean, it is listed in accounting statements, right? The exposure of the operating cash flow depends on the effect of random exchange rate changes on the firm's competitive position, which means that now asset liability easy because it is recorded in financial statement. But for operating cash flow, you basically need to forecast. It's not measurable because we don't know how much actually competitive position will be changed by changing in exchange rate. And exchange rate is basically randomly changes, right? So it means that it's very hard to measure. In many cases, operating exposure may account for the larger portion of the firm's total exposure. So operating one is huge. So if you define this operating exposure is basically the extent to which the firm operating cash flows are affected by exchange rate. So how much operating cash flows will be affected if exchange rate changes? So let's look at the case. Suppose that the United States computer company has a wholly owned UK subsidiary, okay? Albion Computers PLC, so that's UK company, okay? That manufactures and sells personal computer in the United Kingdom market. Albion Computers import microprocessors from Intel, which sells them for $512 per unit, So Intel is US company, right? At the current exchange rate of $60 per pound, each Intel microprocessor costs 320 pounds is 512 divided by 1.6, right? Albion Computers hire British workers and sources all the other inputs locally. Albion faces 50% income tax rate in the United Kingdom. Okay, that's a scenario. Now, suppose that we have just the same situation as we have, and let's project the cash flows. So let's say we can sell the 50,000 unit at 1,000 pounds per unit. Then you're gonna get 50 million pounds, right? 50 million pounds. There will be variable cost. If the variable cost is $650 per unit, and you sell 50,000 units, then it's gonna be 32.5 million pounds. Let's say fixed overhead is 4 million and depreciation allowance 1 million, then your EBIT is basically taxable income is $12.5 million. So 50 minus 32.5 minus 4 million minus 1 million, right? So that's $12.5 million. And then income tax is 50% high tax country, right? So you pay half of them as a tax. So your net profit is $6.25 million. And you have to add back the depreciation because the depreciation is not cash item. So eventually, your operating cash flow in British pound is 7.25 million pounds. And then because the exchange rate is 1.6, so in US dollar term, it's going to be $11.6 million. That's operating cash flow projections. It's quite common, I believe. I mean, we practice a lot in many, like in intro finance class, financial management class, how to get the operating cash flow. It's fairly simple. Now let's consider the change in exchange rate. If exchange rate changes, there are two effects may happen. The first is called the competitive effect. It involves the difficulties and increased costs and shipping. So if the pound is depreciated, then it may affect operating cash flow in pounds by altering firm's competitive position in the marketplace, right? So that's competitive effect. Now the other is the conversion effect. Now conversion effect basically lower dollar price of import due to the foreign currency exchange rate depreciation. So a given operating cash flow in pounds will be converted into lower dollar amounts after pounds depreciation. right? So if pounds is depreciated, then what happens is now you actually get lower dollars. So we actually can divide the case. Maybe we set up 3 cases, scenario analysis again, and calculate again the operating cash flow in pounds and dollars. So let's say there are no variable change except the price of the imported good. So now unit variable cost imported sources rise actually if the pound depreciated. So previously it was, I believe, the 160. Now it becomes 140 pounds. So 140 per pounds. So pounds become depreciated, get cheaper. Let's say you change just the value of pounds, right? Then what happened is we actually change a little bit here. Because these dollars changes now, it was 320 pounds the cost, right? Now we have more cost actually. So the cost of imported input is rise to, so 512 divided by now 1.4, now 1.6, which is 366 pounds. Which means that you have increased variable cost basically. Okay, so your variable costs, let's say, increased to 696 pounds, comparing with the previous example, 650 pounds, right? So now your variable cost increases, and you have same fixed overhead costs and depreciation allowance. Then you have taxable income, $10.2 million, I believe is declined because your cost increases, right? And you pay tax, and your net income is 5.1 million. You have to add back depreciation, then you have 6.1 million pounds operating cash flow because your variable cost increases because your importing goods price increases, basically the value increases. And also if you so that's a competitive part effect, and there's conversion effect because it's 6.1 million pounds now should multiply by 1.4, not 1.6. So it's actually lead to lower US dollar value too, which is conversion effect. So competitive effect is you have some certain kinds of price increases because of the import goods, because you import processor from Intel, you pay dollars, but you need more pounds to pay the same amount of dollars, right? So your cost increases. And then also when you convert the pounds to the US dollars, then the value also decreases. So comparative effect, is the increasing the cost. The conversion effect is in the decreasing the dollar cash flow, dollar operating cash flow. Okay. Case 2. Now the selling price also, as well as the price of imported input changes, is no other changes. So let's say that, well, Albion can raise the selling price to 1,143 pounds to keep the same selling price 160,000 after pound depreciation. So pounds also is depreciation from 160 to 140. Now they increase the price too, and say that even though they increase the price, let's say they all have the same sales numbers. Then what happened is they have more money coming in because they increase the price, but they also have higher variable costs and fixed costs and depreciation. Then they have the taxable income, and then they have the taxes 50%. 8.6575 pounds is the tax, the net income plus 1 million. Operating cash flow is a $9.675 million, which is same as 13.545 million US dollars. Comparing is, first one is actually increases because they raise the price. They raise the price. They raise the price. It only happens if Albion computer does not face any serious competition in the British market, though. If the market is highly like the elastic, so it means that, well, if the price changes, then people are very sensitively change the vendors, like the product, so they find substitute. Then you cannot analyze like that because you don't sell this much, right? If they are kinds of the dominate the market, they are the only source, like Apple, you know, iPhone maybe is a good example. iPhone keep increasing the price, but people buy tons of iPhones because even though they have Android substitutes, people still have good loyalties to the brand Apple, and you know, they don't really not seriously compete against the Android phones actually, right? So they can raise the price all the time. If it happened to here, the Albion computer actually does not have much competition, and that they basically dominate the British market, then they can just raise price. However, sometimes, many cases, they cannot do that. So let's say all variables are changing now because they raise the price. They raise the price. Now number of sales declines. Right? They change the sales volume, sales price, and the price of both locally sourced imported input change everything. And let's say they only can sell 40,000 units, and the price they can get is the 1,080 pounds, and the variable cost is 722 pounds. Again, you calculate the operating cash flow in pounds and dollars. Eventually, it's lower than kinds of the original case. So this is case analysis, like scenario analysis again. There are 3 cases you can see. So benchmark case 160, now depreciate to 140, case 1 to 3. Case 1, it only changed the cost. Case 2, it changes the price and cost. And case 3, it changed everything. Eventually, you have some losses, right? So you can set up many other cases as you want and analyze it, so that you can calculate the amount of extent of the operating exposures. Okay. Again, you can program using computers, using using computer program, you can simulate them too. Yeah. So it's all statistical job again. Yeah. So what is the determinants of the operating exposure? Again, the operating exposure cannot readily determined from the firm's accounting statements, as they can do transaction exposures, right? The firm's operating exposure is determined by 2 factors. One, the market structure of inputs and products. Competition important, monopolistic, competitive, pure competition market, oligopolistic market. The market situation matters actually. And then also the firm's ability to adjust this market to product mix and sourcing in response to exchange rate changes. So if you diversify your sources, such as, well, so you need to import everything from China, then you're probably exposed to the yuan dollar exchange rate, problem. But if you can get sources like your supplier from China, you can switch to Vietnam, Indonesia, South Korea, Taiwan, then you can diversify your risk actually. So depending on how you can adjust. So how to manage this operating exposure? They show 5 ways. I skipped the way to use complicated calculation. I just want to explain how they do. So first one is selecting low-cost production site. They can change the production site, right? So they may wish to diversify the location of its production site to mitigate the effect of exchange rate movement. So if their production site is in, say, Mexico, then their peso dollar exchange rate matters. They probably can have Mexican factory, but also can the Guatemalan factory, Peruvian factory, or Brazilian factory, so that you can diversify these locations. That's one example. So for example, Honda built North American factories in response to the strong yen, right? So strong yen, if they produce in Japan, they lose competition. Their competitive position bad. So they moved the factory to the North America, to the United States, to avoid this problem. Later found itself importing more cars from Japan. So Japanese yen becomes weaker. Then they produce more in Japan. So they have factory in Japan and in the United States, and they change the amount of cars that they produce based on the exchange rate. Possibly good, right? Flexible sourcing policy. So sourcing doesn't apply only to components, but also to guest workers. For example, Japan Airlines hired foreign crews to remain competitive in international routes in face of strong yen. So instead of hiring Japanese people who got paid higher yen, because they get paid yen, right, yen basis, they hire people in the US, they hire people in Korea, they hire people in Indonesia, and they pay less money actually. But later contemplated a reverse strategy, because yen become weaker, and if dollars become stronger, then they hire more people in Japan rather than in the United States, so that they save money. So depending on the situation, like they can flexibly change the sourcing policy. Diversification of the market. I mean, they can sell in multiple markets to take advantages of economics of scale and diversification exchange rate risk. So many MNC, multinational companies, sell goods in various markets, so that they can expose some exchange rate risk from one market, but they can get offset from other markets. Okay, so that you can get benefit from diversifying the market internationally. R&D and the production differentiations. So successful R&D basically lets you cut the cost and enhance the productivity and differentiate the products, basically. These gives you better position in the market. I believe Apple is a typical case. Samsung is probably another case too. So successful product differentiation gives the firm less elastic demand. iPhone, clearly, right? So they are not exposed that much exchange rate risk, because they can raise the price. I mean, they have some problem because they only produce in China. That's probably the problem. So they may need to diversify their production locations, but actually having multiple production location also generate the problem. So there's a pros and cons, benefit and the cost. They have compare. Obviously, their strong R&D and the product differentiations basically allow them, the Apple, to have a better position all the time in the market, so that they can raise the price freely. And even though they raise the price, they don't lose a lot of customers. Okay, so that's R&D and the production differentiation. Finally, they can financially hedging using the financial securities. That's all we did actually previously, right? So they could use the futures contract, option contract, forward contract, swaps contract on the money market. Using financial security and the skills, they can hedge against this operational hedging too. This is not easy, however. The financial hedging basically is distinct from the operational hedging. They really try to minimize the volatility in the near term, like in the near future. So you can do the financial hedging too. All right, so I'll finish chapter 9 here. If you're more interested in the financial hedging itself, there's a case next to, I mean, not our case actually, the case in the book. a small case in the book about this financial hedging. You can actually go to textbook and read it, and it's not going to be that difficult, like complicated. But you know, you can practice there actually about the financial hedging. But I'm not going to ask that question in exam, because I'm just skip it because we have a lot of things to do, right? So thank you for watching the chapter 9, and see you next chapter. Goodbye.